Hi everyone. In this video we are going to learn about difference between structuring and smurfing in AML. How I deeply understood the difference between structuring and smurfing in AML. When I initially entered the AML and financial crime domain, structuring and smurfing sounded almost identical to me. Both involved breaking large amounts of money into the smaller transactions to avoid detections and reporting thresholds. But while working on a real world AML scenarios, I realized there is a major operational differences between them. Here is the simplest way to understand it. Let's talk about the structuring. Structuring happens when one individual deliberately splits a large transaction into the smaller or multiple smaller transactions to avoid triggering regulatory reporting thresholds. The person is still controlling the money directly. Example, suppose a bank has reporting thresholds of rupees 10 lakh and a customer wants to deposit rupees 40 lakh in a cash without attracting attention. Instead of depositing 40 lakhs at once, the same person deposits 8 lakhs on Monday, 7 lakhs on Tuesday, 9 lakhs on Wednesday, 8 lakhs on Thursday, and 8 lakhs on Friday. Individually, each transaction looks normal, but collectively the patterns become suspicious. As an AML analyst or FinCrime investigator, this creates red flags because first, transactions are intentionally below the reporting limits. Deposits happens frequently within a short period and customer behavior change suddenly. Activity may not match with the customer profile. This is called structuring. One person, one controller, multiple splits transactions. Now let's talk about this smurfing. So smurfing is more organized and complex. Instead of one person splitting transaction, multiple individuals or smurf are used by one hidden organizer to move money through different accounts or locations. The main criminal stays behind the scenes. Example, an organizer wants to launder 1 crore rupees. Instead of using one bank account, he uses 20 people's. Each person deposits 50,000 rupees into different banks accounts across the different branches and cities. Then the money is transferred to one central account, converted into the crypto, sent internationally, used for illegal purchase. Individually, those 50,000 rupees deposited may looks harmless, but when investigator connects shared phone number, similar devices, IP address, same beneficiaries account, similar transaction timing, and common withdrawals patterns. So the bigger money laundering network becomes visible, and this is called smurfing. And honestly, smurfing is much harder to detect because the activity is fragmented across many accounts and individuals. The biggest lesson I learned in ML is this: criminals rarely move money in obvious ways, and the real challenges is identifying hidden pattern inside normal looking transaction. Thank you so much. I hope you understand the difference between the structuring and smurfing. If you find this video will be helpful, please share with your friends, family member, or who wants to make their career in the banking sector. Thank you so much.